Here we go, real deal. And low float, short squeeze. What's the difference? Do you want to trade one, not trade the other? Like, why is one squeeze different from another? And I feel like it's a pretty important question to ask today. But first things first, as a trader, does it matter if a stock is going parabolic because it's got a short squeeze, or does it matter if the reason behind the move is that it's got a very low float? Well, to steal it from The Rock, it doesn't matter the reason the stock is squeezing, because the fundamental principle is exactly the same thing. And for those of you that, if you're interested and you go back and you look at famous short squeezes back in the day, go read about Volkswagen, or more recently, the meme craze and GameStop and AMC and all that good stuff. But if you've been trading in the last few months, the different type of squeeze, and really the bigger types of squeezes, have had nothing to do with how many shares are short. So it hasn't been about people betting against the stock with short positions and then too many shorts piling in, so when the stock rises, there's a crowded trade to the exit, there's not enough liquidity, and they're just essentially trying to find offers that aren't there because you've got too much of the float soaked up short. That was the play. Recently, the play has simply been, well, there's just not enough shares out there in the first place. So if there aren't enough shares out there in the first place and the float was just too small, or the available float was too small, you've been getting all of these squeezes. Now, what does it look like? What can it look like? It could be anything from a stock like the one I'm going to show you here today, BMR, which has a 3 million share float, has done, as I'm watching it today, 112 million shares traded, is up 1,000%. The short float on BMR, if there's your float, 3.4 million, the short float, 1%. It doesn't matter whether people were short into this overnight. Completely irrelevant. Up 1,000% regardless. Because 3 million available float is nothing. The stock closed at $2. So when it was gapping up on news of a deal with NVIDIA and was already at $4 in the pre-market, you're talking about a very small notional value of available shares. That's essentially nothing. It's $7 million. That's a prop trader's account on a floor. So for that to get bought up, now if the majority of that gets bought up and you don't sell, then who are you hitting on the offer for anybody that might be short? It can be a very small amount of short traders out there, but anybody that needs to buy back, there were never shares there to begin with, and there's even less now as it starts to go higher. So the mechanics are basically the same thing. It's the lack of an offer in this particular case and no liquidity. But it's not because people are stuck short it. It's because the float's so small and someone can soak it up with a small amount of buying power. And once it's soaked up, absolute nonsense can occur. And then it's just like any other squeeze. Now, the one difference for this type of squeeze, I will get this out there, they tend to revert a little bit faster. It's not the same thing as trying to unwind a big hedge fund short. Typically speaking, these go so parabolic, it works both ways. If someone soaked up that float, it's harder for them to get out on the way back. So they tend to come down pretty quickly, sometimes on the same day. But you might be asking yourself, is this only going to happen on low float names that I've never heard of, like BMR getting an NVIDIA deal? And the answer is a resounding, it doesn't just happen on smaller names. This can happen on a company that you've all heard of, like, not AMD, I want to say ARM. Okay, there we go, ARM. I had AMD on the mind. ARM, why is this one making a similar parabolic move to the upside? And let's look at the daily chart for a second. How does this happen on a company that is in the technology is in 99% of the smartphones out there in the market? It's a very popular investable name. How does that happen to the stock? Because SoftBank owns 90% of the company. And when they own 90% as of the IPO, and that's all that got released, there's a limited amount of shares available in a name that a lot of institutions want to own and want to buy and hold. So you have a lot of buy and hold when there's a limited amount of shares, and when it starts to go, anybody that shorts it and its valuation is insane, well, not insane, but it's a little bit high, you can get squeezes like this. So first things first, that you've got to remember. It doesn't matter what the short float is. If you have a low, relatively low float name that starts to break out and go parabolic, you immediately jump away from normal trading mode and go right into this thing is nuts. This is like a GameStop. ARM is not GameStop. ARM is not AMC. It is a legitimate company that will be here for a long time, and they're gonna make money and all that good stuff. But when it makes a move like this, it is now a squeeze. It might be a different type of squeeze, but it is 100% a squeeze, any shape or form of it. And you've got to switch gears. And I'm going to show you the example of that in my trading, because I sold some of my personal account. I'm hating myself for it, but I was looking for, hey, it's giving me consolidation shorts where I can risk 50 cents to try to make a couple of dollars. And then the second, I was thinking short. So when it gave me an in entry here, like, okay, maybe I'll make a couple bucks back into VWAP. Once it broke out and started going stupid parabolic, you then have to make a totally different trade. I went from risking 50 cents to try to make a couple of dollars on a pullback to I'm now going to try to short it, risking $3, $4, $5 to make $10 moves. And that is a switch that you have got to flip because it has gone from one phase to another. And if you just put stocks in the category of, well, if it's got a high short float, I always trade it that way. It's like Carvana, I always am in that mode. Then you're going to miss out when something like this happens. ARM does not have a high short float. And it might be getting higher as it makes moves up, but it has nothing to do with that why it's going. So when you're scanning for things that might give you parabolic movers or reasons to trade it for bigger percentages, it's not just about that short flow, which everyone likes to talk about. Make sure on your scanner, if I use Trade Ideas here, I make sure I got a field for the actual float. When you have an IPO come out, how many shares are available? Who's holding on to the boat? When does the lockup expire? All these things become very, very important. Because if you're not aware of that, then you might get caught trading ARM thinking it's going to move like a regular semi stock that has 100 billion market cap. And it's not. That's just the way it is. Because there is fundamentally no difference between a lack of offer because there's too many people short or a lack of offer because you've got too little amount of shares available in the float. It doesn't make a difference. The point is, nobody can hit the offer. There's no offer to hit. And that's the fundamental principle why it happens this way. And it works in both ways on the way down. That's what you see with this chart. You're just going to get outsized moves. So you accept that rationality has gone out the window in trading, and you are now moving into almost like a meme mode on a stock that you wouldn't have thought about it for. So you always have to be able to take that step back and assess what is going on in that stock. The why can be important, but switching gears, like we talked about last week, is more important in the moment. So understanding why this can happen in a name like ARM so that you can switch gears very quickly. It behooves you to do it as a trader. It might make you flip into the long a little bit faster. It certainly will make you more patient if you're trying to fade something like this. So whether it is that, whether it is BMR, the new game is not necessarily about that big short float. It is about the low floats. And I'll give you one last hint as to a catalyst that you can see for why you will get low float runners and what is the biggest catalyst recently for them. And I'm going to pick on you, Mullen, because that's what I like to do every now and then. And that's going to be the reverse split. So the easiest way to see the float get tiny on a stock is when they reverse split. And how many times have we seen a pattern, stock reverse splits, falls like you would expect it, but then because the float is a lot smaller when you reverse split, they do these crazy irrational breakouts. So reverse split on Mullen, it tanked like you would have expected it to tank. That's what bad companies do. And then it made a huge rally off of lows. Could it do it again? I don't know. But I know that because the float is smaller, it can start doing things that you normally would equate to your GameStops, for lack of a better term, your Carvanas. They're in the same kind of pocket because the float is small. So at the end of the day, as I said, it does not matter why there is nothing to hit on the offer. Just understand that a squeeze is a lack of liquidity as the stock is going up. Doesn't matter why, whether it's a low float or whether it's a short, whether it's just simply too many shares short, it's going to effectively be the same thing. And you've got to trust in yourself to adjust your trading accordingly. So you're seeing a lot more of these low float runners. I don't think this is going away because I've never seen so many things on the market trading with less than 1 million shares available or under 5 million shares in available float. So this isn't going anywhere, and you've got to be able to adjust your trading. That's the real deal. Short float versus low float, it doesn't matter. They can both squeeze.